This week I bet $30,000 on a stock I believe is deeply undervalued, but should you also buy it? In this video we'll explain why I believe this stock will beat the market, likely double in price and make us a lot of money. But before I reveal the stock, let me show why it's worth your attention. I didn't just YOLO in blindly. I manually filled out spreadsheet after spreadsheet after spreadsheet, ran thousands of calculations and compared more than 100 companies just in the past months. I finally discovered a system that works for me. Now I'm putting my money where my mouth is. Remember, this is not financial advice. It's clearly entertainment, just an insight from someone risking real money. Let's jump in. I wanted to invest in a soft beverage company. These are easy to understand business with very good margin, and people will always need drinks. So here is a short list of our options. We have Coke, Pepsi, Dr. Pepper, Monster, Celsius, and Fizz. Which one do you think is the best deal? Can you guess which one is the most undervalued? Make your choice now. Let's answer these questions using my value ratio. Like every ratio, we start with the price. In my case, I like to use the investor price, a slightly modified enterprise value I explained in this previous video. Here is the investor price in millions to get a true sense of each company real cost. Everything is simple so far. Coke is the biggest and Fizz is the smallest. Next, we look at cash flows. For profitable companies like this, I like to use Buffett owner's earnings. Generally, valuation are linked to potential profits, so I calculate each company real earnings from operation, not the one you see in the income statements, as shown in the column here. That gives us the first row multiple, investor price over earnings. Monster seems to be the most expensive at 30.52, meaning you pay $30.52 for every $1 of real earnings, while Celsius is the cheapest. But like I said in my PE video, these multiples say nothing about growth and risk, two very important factors when investing. Therefore, we need to modify this ratio to include these two variables. Let's start with growth. One of the hardest parts in investing is predicting the future growth. The soft beverage industry have averaged around 7% growth in the last 5 years. After reading hundreds of articles, asking ChatGPT, checking analyst prediction, and using common sense, here are my 5 years forecast. Let's start with Coke. They are everywhere already, also in my fridge. So it's very hard to grow from here. And as you can see in the revenue chart, they are quite flat, 3.5%. Pepsi, very similar, big and stable, 3.25%. Dr. Pepper, smaller, with more potential. Recent trends kind of supports that, 4.5%. Monster, good growth, but slowing because of competitors like Celsius and Prime. 6.5% I think is appropriate. Celsius, very controversial. Some say 20%, others see this as the beginning of the decline. Personally, I'm impressed with the trend and I believe it could expand well in Europe. Where I live, I can't find it yet, but I would like it to try, so I see that as a big opportunity, 10%. Fizz, management seems more focused on dividends than growth, 2%. Celsius has the lowest investor price to earnings and the highest potential growth. Mamma mia, that's pretty interesting. But hold on, risk can change everything. In my value ratio method, I assign each company a risk from 1 to 100, evaluating different parameters. First, are all US companies, so minimal country-related risks. We are not dealing with China, we are not dealing with Africa, we are not dealing with Italy. I love Italy. Great for food, but not so much for the economy. Second, are all profitable companies, not unprofitable startups, so low risk there. Third, debts. Coke has some debt, they can pay it off with a couple of years of earnings. Pepsi has more, need 4 years of earnings to clear it. Dr. Pepper is quite concerning, with almost 7 years of earnings in debt. Fizz, Monster and Celsius are great, have 0 net debt. 4 is dilution risk, is low in all of them, and 5 is hyper risk, Also, none of them is especially hyped right now, so my final risk scores are Coke 12 out of 100 due to debt, Pepsi 25, more debt, Dr. Pepper 35, even more debt, Monster just 1, no debt, incredibly safe, Celsius 9, no debt but some distribution risk from dependence on Pepsi, Fizz 5 with a very good balance sheet. Combining the investor price to earning with growth and risks give us the value ratio. Now the exact formula is too complex and can't fit in a 10 minutes video, but with these inputs here are the results. For example, Monster multiple drops because of acceptable growth and zero risk, while Dr. Pepper gets penalized for its high risk connected to debts. Pepsi at 27 and Coke at 25 are very interesting because they are the biggest cap and they are in perfect alignment with the market median of 26 for the 150 company I track. That suggests that they are perfectly valued relative to the broader market. The market might be underpriced, undervalued or overvalued, as I suspect. Anyway, they are in perfect alignment with it. Monster and Fizz are slightly undervalued but not low enough for me to invest. By now I'm sure you guessed which company I bought. Celsius. Based on the value ratio to reach 26, the market median, the price should be around $46–47, implying an 85% upside from today's price. Obviously no guarantees, anything can happen in the market, but I do believe in the value ratio, I believe in my system, I believe in all the research I've done, therefore here is me buying 500 shares of Celsius, bringing my total to 1,000 at an average price of $28.71. We will follow this investment in the coming months and let's see if the earnings at the end of February are the turning point for this stock. So subscribe if you want updates, including when I might sell. Do you own Celsius or any other beverage stocks? Drop a comment below and let me know. That's it for today. Peace out.